12 million businesses are owned by baby boomers right now. Let's just put this into context for a second. 12 million that will change hands over the next decade, 12 years. Let's just call it a decade. 60% of those businesses will probably never be sold. They'll probably just be shut down.
All right, guys, welcome to another episode of The Report. Today, we are in the studio here in downtown San Diego, and I got a special guest who's actually living in my hometown of San Clemente, and super excited. We're going to be talking all sorts of stuff, talking what's going on in the economy. We're going to be talking about his exits and everything that he's working on. He owns $25 million in real estate. In addition to this, I got my man, Mark Moss. Mark, welcome to the show.
Yeah, Rich, thanks so much. What a pleasure getting to know you. And man, we barely got enough time to record because we've been talking so much.
I know. We've been talking for like an hour and 20 minutes, and I'm like, dude, it felt like 10 minutes.
Yeah.
I'm like, we better jump in.
We got a lot to talk about.
Yeah. How long you been living in San Clemente for?
I moved there when I was in like middle school. My parents moved there. We were living in Texas, and my dad was in construction. And when the oil market crashed in Texas, my dad's like, head west, young man. So moved to California. So I moved there when I was in middle school. So kind of ever.
That's crazy.
Yeah.
So we were probably living there at the same time. I grew up there. I moved out of there when I was like 17, right when I graduated high school, turning 18, 2003.
Yeah.
But my family's still up there. My parents live there. My sister, brother-in-law, everyone's all up there. So I go up there for holidays. I'm up there to visit my fam all the time.
Yeah. So you're in my studio next time you come up there.
Yeah, let's do it.
Yeah.
Let's do it. Tell me about your studio.
Yeah. So, man, right at like downtown San Clemente, like old City Hall, basically. I got a 1,600 square foot studio, and most of it's just turned into studio. So video walls, probably $100K in equipment, all the cameras, the lights, all that.
Yep.
And mostly just me shooting my YouTube videos. I have a nationally syndicated radio show on iHeart.
No way.
So I shoot a radio show out of there. I have a podcast on iHeart as well. And then I have the YouTube channel. So we do a bunch of different types of content. So more educational stuff where I have like a whiteboard and I'm kind of teaching. That's like YouTube stuff. So it's like graphic heavy. And then, like I said, like the radio podcast, which is just verbal. And then the space is like pretty big. So then I've done some like live events into there. We put some like classroom tables, bring people in, do some like virtual events, but also like live events and stuff like that. I got a hotel right next door.
Really?
So it's like perfect. So like people can fly in, they can stay right next door. We can get 30, 40 people in there for a little mastermind and do stuff like that. So studio is pretty sick. The story kind of ties into what you're doing is I built the building. So it's a mixed use building. It's commercial on the bottom. It's residential above.
I love that. I've always wanted to own a mixed use building.
Yeah, it's a beautiful building, subterranean parking.
Okay.
It's right on the freeway, right between.
What does subterranean parking mean?
So underground.
Got it.
Right,
Okay.
underground parking. And there was two projects, that and another one are the ones that did me in. I started buying real estate, bank-owned real estate right out of high school. Didn't know what I was doing. But my best friend's grandfather owned Downey Savings and Loans, which used to be a really big bank around here. They went under in 2008. But he had helped this Mexican dude from LA that barely spoke English buy and sell properties from the bank, and it was crushing it. He was a millionaire. Could barely speak English. And he said, hey, take my grandson, show him the ropes. So that was my roommate at the time, and I kind of saw what they were doing. I'm like, well, I want to do this. So I started buying and selling real estate. Anyway, spent a decade. We can talk about that. Spent a decade fixing, flipping. Then I started building from the ground up. And then, I worked my way up, bigger projects. And this project in particular was a $12 million building, and I had it for sale. I had an offer for $11 million, and I turned it down.
What year did you build it?
So
And what year were you
2007.
selling? 2007. And what year were you trying to sell it?
2007.
Okay.
So it took a couple years to build, right? So these projects take years, 4 or 5 years, right? From the time you find the land, you get it zoned, you go through the city, all that. I turned it down for $11 million. I think the payment, if I can remember now, $180,000 a month or whatever it was.
This is the bridge note or the construction loan?
Yeah, everything I did was hard money.
High
right?
interest. Okay.
So as I said, my best friend's grandfather owned the bank, but he had a hard money loan business on the side. And so after a decade working with him, I could just sign my name and have cash delivered tomorrow. It was pretty good. But yeah, so it was a high interest note, and I couldn't afford to carry the building. And it went back to the bank. They sold it for $4.
Damn.
They sold
After
it.
the crash.
They sold it for $4.
What year was that when it traded?
So that was probably like 2008, right?
Yeah.
So from 12 million to 4 million in a year. A lot of people tell me, oh, California real estate didn't crash that much. Okay, well, I lived it. I can tell you otherwise, right? So anyway, so that was one of the buildings. There was 2 projects I was in that were both about the same size, and they kind of did me in and kind of crushed me in 2008, and now I'm renting from them. But it's a beautiful studio, ocean view, right there at Del Mar, right where all the restaurants are and stuff like that. So
I was gonna say that's a nice area, congested. Did you have to tear that down or did you buy the lot?
Yeah, no, it was just dirt at the
It was
time.
just dirt.
Yeah, it
Wow.
was just dirt. So
A
there's
block
there's
off of
still
Delmar Street.
quite a few
Yeah.
little infill lots around town.
Yeah. That's
Yeah.
crazy, man. What is that thing worth today?
If I had to guess, I think it's probably worth 15, 16 million.
Mm.
That's probably my guess. And I think that'd be based off of like a cap rate, right? Probably 15, 16 would be my guess. I talk a lot about wealth transfers. What I learned after getting smashed in 2008 is that money is like energy. So the law of energy is you can't create energy, energy transfers. So money is like energy, money transfers. So when I lost my money, somebody else got it. So there's certain events that create these wealth transfer events. A lot of people are talking about, I think we talked about this earlier, like all these boomers that are going to be selling businesses. That's a big wealth transfer. When they die, all that wealth will transfer. Also, market crashes. In 2000, the stock market crashed. 2008, the housing crash. That transfers wealth. And so a lot of people say, well, what does that mean, Mark? Well, I had that $12 million building and I lost it, but it didn't just disappear. It went to somebody else. The people that own it today are the ones that bought it from the bank and they bought it for 4. They bought it for 4. Now they own it. It's worth whatever, 16 million. The wealth that I had transferred to them now.
Mm-hmm.
Now they have the wealth.
Yeah. Yeah.
Right.
We just bought the most recent deal we bought was direct from our lender, and they had just foreclosed on the property from the initial developer. And similar situation, but this gentleman had a bunch of other projects go bad, cross collateralized some of those other projects onto this property, stopped making the debt service payments. They took it back. You know, as you know, these bridge lenders, private lenders, they're only in typically on 50 to maybe 60% of the ARV.
Yep.
So they take it back and they can still make a little spread, and then the next buyer gets a huge discount. But yeah, I mean, speaking of the transfer of wealth, we got 40 million baby boomers retiring in the next 7 years. They're calling this the greatest transfer of wealth in American history. There's going to be a lot of opportunity. There's going to be a lot of wealth changing hands here. Where do you most see or foresee the opportunity for a lot of folks listening to this podcast?
Oh boy, there's so much opportunity. It's hard to say. And it's interesting that I say that, right? Because right now there's so many people that are scared. I hear people saying that like, today is worse than any time in history, or, we have it worse than our grandparents had it, things like that. The millennials talk about the boomers ruined everything, all these things, but it's just never been easier to make money than it is right now. We have trillions of dollars moving through the system at all times. You can literally pull out your phone and meet anybody, learn anything, and make 6 figures easily just over Instagram, right? So it's pretty good. So there's opportunities everywhere. There's a lot of opportunities to specifically the point that you're asking, I think, with the baby boomers and that transfer of wealth. I think, one, the baby boomers have all this wealth that's going to be transferred down to the next generation. So that's their kids. And so that creates a lot of opportunity. One, a lot of those kids don't want that.
Mm.
So they'll sell the properties, they'll sell the businesses and things like that. So we'll probably see a ton of properties and businesses change hands. That's one. Two, a lot of it probably will get lost and squandered and so forth. So I think there's a lot of opportunities around that specifically. A couple that I would point to would be, one, in the business side, for example, right? So 12 million businesses are owned by baby boomers right now. Let's just put this into context for a second. 12 million that will change hands over the next decade, 12 years. Let's just call it a decade. 60% of those businesses will probably never be sold. They'll probably just be shut down. My dad, for example, had a construction business forever. As I said, we came here doing construction. His phone rang off the hook. He had it for decades. I didn't want that construction business. None of my brothers and sisters wanted the construction business. Literally, that thing just printed money. His phone just rang and he just shut it down, right? So about 60% of those businesses will be shut down. That means about 40% of that 12 million will transfer, let's say, over the next decade. Now, just use numbers, 400,000 a year, something like that. To put that into comparison, last year, about 35,000 businesses sold.
Mm.
So we're looking at going from 35,000 businesses a year being sold to 300, 400,000 businesses a year. That's a big deal. That's a big wealth transfer. I think that means a couple of things. I think, one, it's a buyer's market, right? So if you're looking to get into the space, we talked about this earlier. A lot of people are buying these businesses. I think that's great. But also, being a buyer's market, the sellers are going to have a hard time selling. And so they're going to have to get their businesses in the best shape possible if they hope to sell it.
Otherwise, they're going to give them away for pennies on the dollar.
Or not be able to give them away at all.
Mm-hmm.
Right?
Mm-hmm.
So I think that's a massive opportunity right there. I think the other opportunity is that you have a lot of wealth is trapped in these baby boomers' portfolios, whether that be in their 401ks, their mutual funds, things like that, pension funds.
And where's that money going to go?
Right. So as the government, they have, the government is your partner, whether you want them to be or not. They like to take about half your money and they have policies. And so they passed a law in the 70s called ERISA. And the ERISA means that you can basically invest tax-free but at some point they want their tax. So once you get into your 70s, you have to start pulling the money out.
Yeah. Otherwise, they penalize you.
Otherwise, they penalize
They know
you.
you're about to die. They got to get
So
the tax
now
money.
we have all these boomers with all this wealth locked up in these retirement plans that all has to start being unlocked and paid. Where does that money go? People don't think about this, but like they're going to spend it. Where are they going to spend it? It's going to somebody. So a couple things about this. So one, that money is going to go maybe to their heirs if they pass it down. So where would those heirs put it? Where would their kids put it? Well, probably not pension funds and gold. Maybe they'll buy Bitcoin. Maybe they'll be buying businesses. I think that's a big trend.
Maybe real estate.
Maybe real estate as well, right? I think that's a big trend. I think the other thing is that part of the reason why we haven't seen the recession that a lot of people have been forecasting, I talk mostly about economics on my channel, and everyone, you go on YouTube and there's no shortage of headlines of people saying that, the world's going to burn down and melt, and Harry Dent's on the news every couple months saying the market's going to crash 90%, but it hasn't. Even though the Fed raised rates at the fastest rate in history, right? Even though the economy looks like it's shaky, it hasn't crashed. And part of the reason why is because these boomers are spending their money. They're going to die. They don't care, right? I've saved up $1 million, $2 million, $3 million, $4 million, whatever it is, and I'm going to spend that money. And so you start to think about what would be the types of things they spend their money on. Vacations, cars, RVs, cruises, things like that. So I think about it in terms of that. So that's where that wealth is going to be transferring to. That's the opportunities.
It's interesting you say that because I've spent a lot of time thinking about how the wealth is going to trickle down and change hands, but I never thought about that aspect that, a lot of it's tied up in these IRAs and 401ks. And I do know, hey, I think it's 72 and a half. They start penalizing you because the government needs to collect their tax money. And so where's that money going to go? It's a very interesting question.
They're either going to spend it,
yeah,
most likely, or they're going to pass it down to their kids who are going to spend it.
Yeah, that's interesting. And I wonder exactly, you mentioned a couple of those industries that will benefit from it, but I wonder specifically how someone could maybe jump ahead of that trend and maybe.
So this isn't one area of economics is studying demographics.
Mm-hmm.
And the reason why is because even though we're different, most of us, our spending habits are predictable. So in your 20s, you're sort of starting out, you don't make a lot of money. In your late 20s, early 30s, you're probably getting married, you're buying your first house, you're starting to have kids. So what you're spending money on has changed. Once you get into your 40s, now your kids are grown, right? You're your peak earning years. So you're in your max spending years and you're spending on different things. Now you're buying the bigger house, maybe your final house, you're buying the nicer cars, right? Once you get into your 60s, now you're starting to think about downsizing. Your kids are out of the house now. Right? Now you're not buying the big house anymore. Maybe you're wanting to sell the big house to move to a smaller house. And anyway, so you can understand how that works. And so even though we're different, our sort of spending habits are the same. So basically what you do is you take the demographics, the population, and you look at the age groups that they have. And as they move through the population or the economy, then what they spend changes. So it's sort of like a snake that ate a rat, right? And you can sort of see that going through. Now, the baby boomers are the largest segment of the population, which has basically set every trend that we've had. So if you look from World War II to today, you can see all the trends that they've developed, including real estate, stocks, et cetera, as they've gone through those buying years. So now you just think about, okay, so now we have that segment, that snake is, or that rat is now at the end of the snake. What would they be buying at this point in their life? But then we have the echo boom generation of the millennials now, which is about the same size as the baby boomers, that all that wealth will transfer to. So then what will they be spending
with a completely different game plan in terms of spending habits, though?
A completely different game plan. And I don't think they're near as savvy, right? So the baby boomers had, if you call it, the benefit of kind of seeing and hearing about the Great Depression. So they were savers. They were earners, right? They built wealth. They built companies, right? The millennials, they don't have that habit. They're not savers. They're not builders. They're not creators. And so I think a lot of it's going to be squandered, which means maybe a lot of easy money being unlocked.
For the ones that are savvy.
For the ones that are savvy.
And the ones that are willing to go out there and make it happen. That's interesting. And I think another interest, I talk about household demographics all the time. And, we're seeing baby boomers live longer. They're not selling their homes and moving into retirement homes at such an early age anymore. So it'd be interesting to see what effect this has on the real estate and housing market as well.
Yeah, one area that I'm really interested in the housing market, and I'm sure you've seen with the boutique hotels and stuff like that. We're seeing a massive influx, especially in Southern California, into like retirement living. And it's kind of breaking that old people's home sort of thing that we used to have. And now it's like, these are like really nice, like condos. Like these are like, I'm thinking like, I'm probably going to go live at a place like that when I get older. Like they're resorts, right? So there's a trend of that. And then I know some people that are really getting into like single family homes and converting those into like assisted living care centers, things like that. So I think that's a pretty good trend in real estate, one that I've been keeping my eye on for a while. It's a little bit more of a business, because you actually have people living there and so forth. But I think those are probably two big trends in real estate. I think overall, also, if I look at real estate very generally, which I don't like to do, I try to remind people all the time that there is no such thing as the real estate market. There's
Yeah.
thousands of markets
It's
broken
hyper
down,
local.
size, type, location, all those things. But I think generally, broadly, like the McMansions all throughout the Midwest, things like that, as these baby boomers are starting to sell those McMansions to downsize to the smaller home and go where it's sunny and they can play golf and tennis, like Florida, for example, I think that's going to leave this big weakness in the market. The millennials are not going to want those houses. The millennials are much more free. They want to be nomads. They want to travel. They want to work from their laptop, things like that. They don't want to buy a 4,000 square foot house in Milwaukee. That was their parents. They lived there. That was the factory was there. They lived there their whole life. They retired there. Now they moved to Florida. The kids don't want to be in Milwaukee. They want to be on their laptop in Cancun. So I think one, that part of the market, the McMansions, specifically in the Midwest, will probably have a lot of weakness moving forward. I think overall, I don't think the real estate performance of the next couple of decades matches of the last couple of decades because of the change in that demographic and how they view kind of putting down roots long term. Obviously, the work demographic has changed right now. People working remotely as opposed to in cities and factories. I also think I'm building a house right now in Mexico,
What city?
In north of Cabo,
Okay.
right on the beach right there in Cabo San Lucas. And I think, we can already see it. Like Mexico is blowing up. Like the whole Cancun, Tulum area over there. I mean, it's insane. Playa del Carmen. In Tulum, I don't know if you've been there, but in Tulum,
I've never been. I still need to go, man. I've heard amazing things.
yeah, I
and,
mean, it's amazing over
um,
there. They just put in a new international airport with like an extra long runway so they can bring cargo in now.
Love
They're
that.
building a train to go from Tulum over to the Pacific coast.
I heard
so
about
now like high speed rail. And Mexico is blowing up. And so again, back to the millennials and thinking about the trends, right? So they want to be decentralized. They want to work from their laptop. They want to be somewhere it's warm, where the cost of living is less. Obviously, inflation is eating people alive in Canada and the United States as well. And like, dude, for $2,000 or $3,000, you can live like a king in some of these countries. And so I think there's a lot of trends in real estate specifically getting into some of those markets as well. That's why I'm going down there.
I agree. And then the other cool thing about being down in Mexico, or Medellin, Colombia, is another popular
Yeah.
city for people to go down and work remote. And you live nicely over there for probably 15 to 2,000, just like you mentioned. But you're in a similar time zone as the States. And
Yeah.
so from you're talking about an entrepreneur going down there and operating their business. From a time standpoint, it's going to be a lot easier down there than, let's say, you're out in Turkey or other
Yeah.
parts of Eastern or Western Europe, where you're 10 hours, 12 hours ahead. That's going to be tough operating a business.
Big time. And the cultures are so different too. That's the other problem.
Mhm.
So like coming from America and going down to Mexico or Central America is easy. The cultures are generally kind of similar. Moving over to, like you said, Turkey, for example, any of the Middle Eastern countries, the cultures are just night and day. It's like oil and vinegar. At least that's my experience anyway. So that's one. The culture, the food's different. The culture's different. I mean, we're in Southern California, so like Mexican food's like our that's
Oh,
our
so good.
jam, right?
And San Diego's the best.
Yeah, so like we love that. So the culture's the same. The time zone for sure. The ease, right? So I can be in Cabo in 2 hours on an airplane. To get to Europe is going to take me 12, 14 hours. Then you got time zone changes. I have a buddy that lives in Colombia. $5,000 a month. He's a baller. $5,000 a month, and he's got like full-time driver. He's got like a couple full-time staff at his house. Like when he leaves the house, comes back, they clean his shoes for him. His laundry's always perfect. He has people that go wait in line for him at restaurants or nightclubs and hold his booth for him. And $5,000 a month.
Yeah, I love that. I mean, I see it and I get it, especially with a lot of things going virtual. The need to be in the office full time is not there anymore with a lot of companies, and so I see it. And I guess from a real estate perspective, to me, it almost sounds like these suburban or more rural submarkets outside of the metros will be more affected than some of these more metro markets and areas to where it's walkable and we have cool restaurants and there's things to do. I kind of see that as more of the trend. I mean, I know COVID put a little stop to it.
Yeah.
It reversed the trend for a little bit. We saw these downtown areas get a little bit more affected with all the homeless populations. And people wanting a little bit more space.
Yeah.
But we're seeing that trend reverse again.
Yeah. And what we also saw was, to your point, a lot of the people in the city sort of moved out. And where did they go? They went to places they could do things outdoors. So they went to Idaho, Montana, things like that. All these places they would have always wanted to go live, but there was no jobs. but because of being able to work remotely now, they could go live in Colorado or whatever that is. So I think when you think about real estate, I think about it in the lens of supply and demand. And I talk, like I said, mostly about economics. And economics, we get into the financial plumbing of the way the Fed works and the Treasury is very complex. But it all boils down to supply and demand. So when I think about real estate, I think about supply and demand. So like, I mean, I'll probably want to go live in the Teton Mountain Range in Wyoming because if I'm a snowboarder or a hiker or whatever, right, mountain biker. But like, why do I want to live in wherever, Kansas, right? No offense.
I don't.
Right. But like there's a draw for somewhere in Idaho, Coeur d'Alene, for example, beautiful lakes and snow and all those things. Or like I said, in the Tetons in Wyoming. But like, why would I want to be in the middle of nowhere, Kansas, for example? So I think there's some people that want the cities. They want the downtown, the walkable, all of that. There's a ton of people that want that. And then there's the outdoor enthusiasts that want that. The ones that have neither of those things, those are the ones that are going to be affected.
Yeah, that makes a lot of sense there. As a busy real estate investor or entrepreneur, time is money and first impression is everything. Every day to make it easy on myself, I wear Built Basics clothing. Whether you're a girl or guy looking for workout gear, joggers, shirts, button-downs, hats, or shoes, Built's got you covered. Super comfortable, tight in all the right places to make you look fresh and clean all the time. Visit BuiltBasics.com and use promo code SUMMERS20 to receive 20% off of your order. Again, that's BuiltBasics.com. That's BYLT Basics.com. Use promo code SUMMERS20 to receive 20% off of your order. Now back to the show. From a supply standpoint, we know that we've been in the high interest rate environment. We had the COVID stuff in 2020, which slowed down new builds. And then now with this rate environment, a lot of builders have put a pause to new builds. They kind of want to see where the market's going to go. And I get it. And then also the cost of construction has gone up tremendously over the last 4 years.
Yeah.
And so, from a supply standpoint, there is a huge shortage of supply out there. I've read various articles saying we're anywhere from 4.5 to 5 million housing units short. This is nationwide of where the demand really is. It will be interesting to kind of see which markets flourish and which markets don't. And to your point, Mark, real estate is hyper local. I think the only thing that is not hyper local within the real estate realm is really the lending environment.
Yeah. Yeah, I mean, obviously, again, back to all the different types of properties. So there's a lot of like higher end multifamily coming on the market. I think we haven't seen all that hit the market. So we'll see how that plays out. But I think there's a really good opportunity. You talked about the interest rates. So the Fed went on the fastest rate hiking cycle we've seen in history. And that jacked interest rates. I mean, single family went from about 2.5% to like 8%. Right.
Yeah.
I mean,
but let me ask you a question, though. So like 2 years ago, if someone told you, hey, they're going to increase the rates from 2.5%, 3% to 8% in a matter of 18 months. And real estate pricing, housing prices nationwide are going to be relatively untouched. Would you believe it?
Well, I have plenty of videos out showing that I kind of said I think they'll hold up. I was not one of the ones. When the pandemic happened and they started shutting businesses down, that was like a pretty kind of a scramble. That we were in no man's land. Who knows what's going to happen? How long would they take this on? But specifically to the raising rates, everyone said when they raise rates like that, prices have to come down. They have to. Mark Twain said, it's not what you don't know that gets you in trouble. It's the things you know for certain. And I said, they don't have to come down. People just buy a smaller house. And that's exactly what we saw. People bought a smaller house. So it goes against conventional wisdom. Typically, well, if home prices gets higher, then people buy less of them. But like I said, people just buy a smaller house. That's exactly what happened. But I think it creates this unique opportunity because specifically, not in the single family market, which is obviously already taken off. We saw just in the last month of last year, December, home prices just went through the roof, right? Not home prices, the amount of transactions and the prices are going up. But specifically in the larger multifamily market that are driven by cash flow. So when you're buying properties for cap rate, the cap rate is the cap rate. And so you have to do the math on that, right? So what's my interest expense and what's my revenue, right? What's my profit? And so you do the math on that. And when the rates went up so high, then that changes what the building valuation is because the cap rate has to stay somewhat in that range. So we push rates up, and that's why we've seen a lot of problems in that large multifamily market. So now people are losing their buildings, it's going back to the bank, things like that. But what happens when I can buy today at a decent cap rate at 7%, and in 2 years from now, rates are back to 2 or 3?
Right. We're gonna start to see cap rates reverse course.
Well, if cap rates stay the same, that means the building valuation goes through the roof, right? So let's say that I'm buying at a 6 cap, for example, right? But interest rates are at 7%. Well, that building's worth $500,000. If interest rates drop from 7% back down to 3 or 4 and the same cap rate, now that building could potentially go up by 50%, 60%.
True. But eventually those cap rates will follow the interest rates. You know, obviously right now we're in a rising cap rate environment because the rates went up. But I feel like there's always a lag period between the rates, the interest rate, and then where the cap rate follows.
Sure. There's a lag, which gives you that sort of sweet spot to kind of take some positions. So I think as the rates switch, and I think a lot of people I'm predicting rates are going to be lowered, probably a lot lower than most people think they will.
At the end of this year?
I mean, if I had to put my prediction hat on, and
let's hear it.
My crystal ball is a little...
We're all speculating.
My crystal ball is a little fuzzy, but if I had to put my prediction hat on, I think we probably see mortgages get in the 5s this year. I think the Fed gets into the 4s, and then, the difference of what the Fed, whatever the spread is. I think the spread comes down. The spread's been pretty high. So I think we get into the 5s, maybe 5.5 this year. That's on single family. But I think over the next, say, 24 months, they probably come down even more.
Yeah.
And the reason why, so Janet Yellen of the Treasury, I've made several videos. I have one coming out probably by the time this airs, it'll come out. And I talk about the battle or the fight between the Federal Reserve that sets monetary policy, interest rates, and the Treasury, the U.S. Treasury, that sets fiscal policy. And they're fighting. And you would think they should be kind of working together because they both kind of represent the U.S. government, if you will. However, they're fighting because they want different things. And so Jerome Powell at the Fed wants to raise interest rates to cool inflation, because if they let inflation get away from them, they look horrible. They're failing to do their job. The problem is, as they raise rates, they're making the government go bankrupt. So as rates go up, people make less money. So I don't have the capital gains for my houses and my stocks, things like that. I don't have as much money to spend. So then the government makes less tax revenue. And then they make less tax revenue, but then the interest on the debt goes up at the same time. So the government's expenses go up and their income drops. So right now, the government, the U.S. Treasury, has been adding $1 trillion of debt every 90 days. $1 trillion every 90 days. Let's put this into some perspective here. It took almost 200 years for the government to get to the first trillion. Then it took a dozen years. Then it took 10 years. Then it took 8 years. And now we're adding it every 90 days.
So that's $4 trillion a year at this pace.
We added 2.7, I think it was, in 2023. I think we'll break 3 trillion this year.
That's insane.
It's insane. So at these rates, the government can't afford that. And then the other problem is that the government has been front loading. So then they borrow on bonds, and there's bills, notes, and bonds. And it has to do with the duration, anywhere from months up to 30 years. The Treasury's been front loading the front end, the short-term notes with the high interest rates. They don't want to refinance it at 10 years or 30 years at these high rates. They need them to come down. So Janet Yellen, I did a video on this maybe a month or two ago. Janet Yellen said that she's predicting that the interest payments on the debt will be 1% of GDP for the rest of the decade. Okay, so that's right now we're spending over $1 trillion a year just on the interest on the debt. It's now exceeded how much the U.S. spends on its military, which is more than the next 10 countries combined. It's incredible.
Say that stat one more time.
Okay, so as of today, the U.S. government is spending more money on the interest on the debt to service the debt than they do on the military.
That's crazy.
And then to put into perspective how much we spend on the military, the U.S. spends more on the military than the next 10 countries combined. More than China, more than Russia, more than Iran, more than all of them combined.
That's wild.
Okay, so that puts it into perspective. So that's unsustainable. As a matter of fact, the Treasury put out a report called it an unsustainable path. And the CBO, Congressional Budget Office, projects that the debt will be $50 trillion by the end of the decade. So that's kind of the path that we're on. So there's no way the government can afford that debt, because the debt's going to keep growing. How can they continue to afford that debt at these high rates? They can't. So back to the math. So Yellen said that the interest on the debt would be 1% of GDP for the rest of the decade. So if you do the math, and I broke all this down in a video, but if you do the math, that basically puts rates at 0.8% on average for the rest of the decade. Back to zero.
Yeah. Wow.
Back to zero.
How long? Because we were basically at zero.
We're at zero
at 2021 numbers coming out of the pandemic. How long till we get back to that 0% Fed rate?
It depends on how fast and how bad things get, unfortunately. So things are sort of it's a balance, like a seesaw, right? So like, unfortunately, when things get bad, they lower rates. You mentioned the pandemic, right? So they shut everything down. Things were bad. They had to lower rates down. Basically, by the Fed setting the interest rate, they're setting the price of money. People don't think about it like this, but like, I use money to buy the iPhone, but I also buy money as well.
What do you mean by that?
If I want to go buy a boutique hotel for $1 million, I don't have $1 million. So what am I going to do? I got to go buy $1 million. How much does it cost me to buy $1 million?
Whatever
That's
the rate is.
That's the rate.
The price for the capital.
So we're buying money.
Yeah.
So by setting the rate, they're setting the price of money, right?
Mm-hmm.
And now if this iPhone's $1,000, I sell whatever, however many I sell. If I lowered the price of the iPhone to $300, do you think I'd sell more?
Yes.
Of course, right? So if I lower the price of money, do you think people buy more money?
Yes.
Of course, right? So that's what happens. So they're trying to get the economy going again, so they lower the price of money. So if the economy starts doing bad, then they'll lower the price of money so people will go borrow more money again.
Yeah, that makes sense. It's all the cost of capital.
Yeah, it's the cost of capital.
Yeah. That's interesting, man. But that breakdown was good. So I got to see this YouTube video when it comes out. What's the name of your YouTube channel?
Mark Moss.
Okay.
Yeah, I thought you were asking about the video. I can't remember what the name of the video was, but yeah, just Mark Moss.
Yeah.
I'm all over YouTube.
That was a hell of a breakdown. So with the rates and all that, I mean, shoot, the Feds come out this year. It's an election year.
Yeah.
And the Feds come out and they're giving a lot of signals that they're going to do some rate cuts. We're seeing a lot more activity in the real estate market, at least.
Yeah.
Plus, there's still a lot of fear out there. And so it'll be interesting to kind of see where that navigates. In terms of, Wall Street and let's say crypto and stocks, it's paper assets out there.
Yeah.
I don't invest in a lot of stuff, but I do watch the markets and it seems like, a lot of that stuff has been doing pretty damn good, especially with all the news lately of the Fed going to be doing rate cuts this year. Is that accurate?
Yeah, I would say a couple things about that. First of all, when you talk about the stock market, so you said paper, right? If you will, equities or whatever you want to call it, right? I'm not that big of a fan of that specifically. I think that anytime you approach a business, if you play sports, if you want to go play basketball, you want to play sports, you want to play in the business world, you need to have an edge, right? So I'm not very tall, so if I'm going to play basketball against some tall people, I have to have a different approach to the game than somebody taller would, right?
Sure.
For example, I have to find what my edge. Maybe I'm quicker, maybe whatever, right? And so everyone needs to find an edge, whatever that edge is. And there's just no edge in public equities. Like the high frequency traders in Wall Street, they have an edge. Ray Dalio's fund, Bridgewater Capital, spending $1 billion on analysts. Maybe they have an edge, right? I don't have an edge. You don't have an edge. No public has an edge. So first of all, I don't really play in that realm. But let's just talk about that for a second. That's back to sort of the same thing with real estate. Everybody said when the Fed raises rates, that's what they call the risk-free rate because it's basically risk-free giving your money to the government. When the risk-free rate goes up, stock prices have to come down. The PE ratio, the stock price have to come down. They have to. Well, they didn't. And part of the reason why I think they didn't, I mean, you could break it down. The 7 tech stocks have basically moved the whole S&P 500 up. If you take those 7 out, the S&P 500 is actually down. So we could break that down. But I think part of it really comes down to a big mental shift that I think is driving the world and really changing the whole world outlook. And that is one of my favorite economists, Ludwig von Mises from the Austrian School of Economics, calls it the crack-up boom. And he said, and then suddenly the people realized that inflation is both permanent and intentional. So a decade ago, nobody talked about inflation. A decade ago, nobody talked about the Fed. It was Ron Paul in 2009 that ran this whole campaign of end the Fed that all of a sudden people started talking about it. We didn't have YouTube and all that talking about it. So now everyone's like conscious of inflation. It's all over the news. We're all paying attention to that. And the government's like, we're trying to get inflation back to 2%. 2% is our target. Cool. So your goal is just to steal 10% or 2% of my wealth per year? That's your goal? So steal 10% of my wealth every 5 years? That's the goal. And so what is he saying? He says when people realize that inflation is both intentional, they're telling us that it is, and permanent, that's their goal, then people lose trust in the money. They no longer want to hold money, and they'll quickly change it for any asset that they can. And so back to kind of house prices and stock prices, even though the price of money is going up, even though that should reprice homes and stocks cheaper, why weren't people selling? Because they realize that holding assets is wealth, not paper currency. One of the best examples of this is in a book called When Money Dies, and it highlights Weimar Republic in Germany. They had this classical case of hyperinflation, and they had to repay all these war debts after the world wars, and they had to print the money. They didn't have the money. I won't go into the whole backstory, but they basically had to print a bunch of money to pay back the debts, and it caused massive hyperinflation. And what happened is, back then, gold was still money, but the German mark to gold ratio went through the roof. Over 9 years, it looks like this massive hockey stick, but it wasn't a smooth line. No assets go up or down in a straight line, so it was very volatile. And what happened is during this period, they saw prices go up, down, up, down, up, down, up, down, and they thought, oh my gosh, this is it. I should sell my house now before it crashes back down. Oh my gosh, I should sell my gold now before it crashes back down. I need to sell at the top. And at the end, they all held a bunch of worthless paper that was worth so little, they burned it in the fireplace instead of wood because wood was worth more than the money.
Mm.
And so that's kind of what we're seeing. Now, that's obviously an extreme example. So sometimes we have to look at the extreme to understand where we're at today. And people gave away wealth. They gave away their assets for worthless paper. What we want is goods and service. We want real estate.
Yeah.
I want Bitcoin. Like on my ranch in Texas, I got cows, right? Like I want assets. And I think that's part of the reason, back to the stocks holding up so well, real estate holding up so well. It's a massive shift that's happening globally.
Yeah. Because what was it, 1960s or late 1950s, 1959, when the U.S. came off of the gold standard.
71.
71.
Yeah.
And then that's when they started printing the money, and that's when we started seeing inflation do its thing.
Right.
But, the Fed's target is 2.5. It's not that difficult to get some sort of spread on that money if you're borrowing at a.
For real estate investors, it's great because you can get leverage. You could basically get free money. I got a couple properties before, when it was still in the threes, right? And locked that in 30 years. And what a gift for us as obviously in the boutique hotels and commercial, you can't really do that, right? You get 5 years probably. But on residential, 30 years, no other countries give you that.
Mhm.
What a gift.
No, it's true. People always ask me like, oh, would you ever invest in, some of these other areas, Greece, Turkey? And the reason I won't is because if you think our interest rates are high here, you go out there to like Turkey, some of their interest rates for real estate is 20%, 22%. So, you're really going to have to pay cash to buy an asset out there. But here in the States, let's say on average you put down 20%. So you're getting a 5x multiple on your money. Well, out there in Turkey, to meet the same return as you would here in the U.S., your asset out there would have to perform 5 times as good just to break even.
Well,
That's tough. That's tough to do.
One, it's the price of the money, to your point, yes. 2, it's that, like I said, you can typically only maybe lock it in for 5 years. So then there's the unpredictability. I don't know what's going to happen in 5 years. So there's that. And then third is the tax benefits.
Yes,
so
that's
part of the
huge.
reason why I still invest in real estate in the U.S., even though I think there's better returns in other places, but I think one of the best reasons is for the tax efficiency, specifically in the accelerated depreciation that we've been able to tap into for the last 5 years.
100%.
Hopefully that gets renewed. We'll see. Let's see.
Yeah.
Hopefully the Republicans can bring that thing back.
I just did a video on that last week on social, and we'll see. And it's going to be retroactive for 2023 and beyond. So I think for listeners out there, if you can maybe not file or delay your
What will be
taxes.
retroactive for 2023?
So last year was 80% bonus
Right.
depreciation. So if this passes, they're going to make 23 100% and beyond.
because they're trying to renew it right now.
They're trying to renew it.
Oh, okay, good. Yeah.
So if you can get an extension right now on filing, I think that might not be a bad idea. See if this goes through.
Don't file.
Yeah.
Pay the penalty.
Yeah.
And a lot of times you can go back and refile it too. Yeah.
So that'll be interesting to kind of see. But to your point, a lot of people are like, they think real estate investing is about cash flow. It's really about debt and taxes.
Yeah, with that accelerated depreciation, it's just insane. I have, let's just say round numbers, right? I have $1 million of profit.
Mm-hmm.
I could we're in California, so I could give half of that to the government, and I have $500,000 left. Or I could buy $1 million property, put $250,000 down, keep $750 in my bank, and have $1 million property.
Yeah.
Right? Take that all day.
It's leverage.
Yeah, take that
And
all
then
day.
you buy a value add property, you turn that million into 2 million.
The property in Mexico, I unfortunately don't have that, right? So that's a cash property.
Mhm.
So from a pure investor lens, like cash flow lens, it doesn't really make a lot of sense.
Mm-hmm.
That's, like I said, a pure cash play. There's other benefits. And that's one thing that I try to hit on a lot, right? Specifically with real estate, like there's a lot of reasons why people buy real estate that are not financially motivated. That's been like a dream of mine to have a house down there. I want that for my kids. I want my grandkids to be able to go use that house, right? Plus, I think about one thing that's really helped me over the last couple years, or I should say decades, kind of change my view, is that we don't want money. Most people don't understand what that means. We don't want money. What we want is the goods and services that money buys us. Money is just where we store that until we're ready to deploy it. So wealth is goods and services, right? And it's kind of going back to that When Money Dies book analogy. People thought they wanted money and they found out money was worthless, right? And so like what I think about is like I create wealth through my businesses by providing goods and services to people. By creating value, I create income. And then hopefully I consume less than I earn.
Mm-hmm.
And then what do I do with that difference? And I think most of it is in saving my money. So I save my money in real estate. I save my money in Bitcoin. I save some money in gold. I keep a little bit for speculation. So when I'm playing some like micro stocks or I'm playing some gold miners or maybe some stocks, whatever, that's sort of like my speculating or
Yeah.
gambling, if you will. And that's a small percentage of my portfolio. But most of it, my real estate, I'm just saving it.
Mm-hmm. Yeah, it's a good way to look at it. I do dabble a little bit with crypto and those sorts of things, but for
Yeah.
me, it's like it's just gambling money.
Yeah. And so even, doing some deals like you or maybe some bigger syndicators and some large multifamily property deals, I can put my couple $100,000 into that deal and like that just stays in there. And if I'm with a good operator
Mm-hmm.
and then I just let it roll into the next project, and the next project, the next project, the next project, the next project. And so that money is now just saved there and it grows. And sure, I mean, I can think about it as an investment,
Mm-hmm.
but the reason why I like to think of it as savings is it gives me that long-term perspective.
Yeah.
Charlie Munger, rest in peace, said that the big money is not made in the buying and the selling. It's made in the waiting. Wait for the right deal to come and then wait a long time for it to materialize. Those guys, Warren Buffett, he bought Coca-Cola in like 1965.
Mm-hmm.
They hold these things for decades. And so that's really where the wealth is. And so, yeah, buy these properties, go into these deals. And if you're with a good operator, like I said, you can let it roll, but you're staying in that deal.
No, you're exactly right. And there's not a lot of investment vehicles out there that, are going to spit off cash flow. You're going to get the tax benefits, so you're not going to pay taxes on that cash flow. And then the equity is going to grow over time. Refi some of the money out. By the way, you don't pay income taxes on the refinances. And then you take that money to get into more syndications or more real estate opportunities, increase the cash flow. You can live off the passive income.
Which is
only
taxed at a lower rate.
Yeah, and only increase your lifestyle as your passive income grows.
Yeah.
And let the equity grow and compound over time. And I think that's the formula for a lot of, limited partners or passive investors.
Yeah.
So I say this, all to really like, there's no investment vehicle out there that really replicates that, at least from like a long-term safety perspective.
Yeah.
Because I mean, let's be honest, a lot of these commercial real estate buildings, they're going to be around longer than we're alive.
Yeah. I spend most of my time talking to the Bitcoin community. So I speak at all the big Bitcoin conferences and we talk about that a lot. I have a fund in the Bitcoin space as well.
Yeah, tell me about your fund.
But I will tell you about it. But I was just going to say, I still think Bitcoin is going to be the best. It has been the best performing asset over pretty much any time frame. I mean, you could pick a couple months here and there, but if you take since its existence, 15
Mhm.
years or say 10 years or say 1 year or say whatever, right? Most of it's been outperforming everything. And I think it will probably continue to be the best performing asset moving forward. And so a lot of people in the Bitcoin space are like, wow, would you ever buy real estate? Real estate's dead. Bitcoin's going to steal all the value from real estate. But they don't understand the tax efficiency and the leverage pieces of it. And so like I would still probably put my cash into real estate so I don't pay the tax on the money. And then I'll pull the money back out of it and then put it into Bitcoin.
Yeah.
Right? Rather than buying Bitcoin directly.
I like
so I think
that.
they're missing that piece there.
I like that a lot.
And so when you're really building wealth, there's a lot of strategies that can really help you out. And so when you think about just buying Bitcoin, they're missing it.
We could call that, we got a nickname that move, like the Bitcoin real estate loophole.
I have a training video on this. I call it the velocity of money. So
Yep.
in economics, a term they use to kind of measure the economy is the velocity of money. How fast does $1 move through the economy, right? So I give $20 to the guy that fixed my car, and he takes that $20 and goes and buys supplies, and that guy goes and buys tacos, and that guy goes and buys more tortillas, right? So how fast did that 120
Mhm.
move through the economy? I think about it the same way, but how fast can I get $1 to move through my investments?
Mm.
So how many jobs can I give $1? So what do I mean by that? So I could take my round numbers, $100,000, and I could put into Bitcoin. And that $100,000 could sit in Bitcoin and it could sit there for a long time and it'll probably grow, and that's pretty good. Or what I could do is, let's say in the next 12 to 16 months, that $100,000 is worth $200,000 in Bitcoin. I think it's probably pretty realistic if I'm putting my prediction hat back on. So now what I can do is, now that $100,000 is sitting there, and now I could sell that $200,000, pay my 50% taxes and get my $100,000 back. Or I could borrow $100,000 against the Bitcoin, keep the $200,000 to still go up in value. Now I have the $100,000 back tax free, and then buy a piece of real estate with it. Now my same dollar is doing two jobs,
Mhm.
not one. It's not sitting in Bitcoin, right? And then I could refinance the building, pull money out and buy a business. And then I get money from the business and buy a truck, right? An example. So like, how many jobs can you get your dollars doing, and how fast, the velocity, how fast can you do that?
Yeah.
It
No,
becomes
it's
very powerful.
And to take it a step further with the velocity of money, I talk about this all the time, is, when we're buying these value add boutique hotel deals, the velocity of money is the greatest in the first 2 years of the project, because that's when we're buying an underperforming asset, we're renovating the property, we're increasing the income via marketing, renovations, technology, good management, and marketing on all these different platforms, that's where the velocity of money is the highest. Now we increase the value, do a cash out refi, now we hold. So years 1 and 2, that's where the velocity of money is really high. And then years 3 through 10, the property stabilized. We're not really, the velocity of money really slows down. And so I always say, like, if you really want to like keep the velocity high with all these real estate projects, do a value add project, pull your money out, redeploy it, or sell after 2 years for a profit, and then redeploy it into another deal, trade up to where you can recapture that same value add component. But
the key with that is to keep the money in. And that goes back to my savings mentality versus investing. Because the investor mindset is like, hey, as soon as that rolls over, I'm going to pull that money out and I'm going to go buy a boat.
No.
Or I'm going to take my family or whatever, right? No, the key is, and you said it earlier, is to leave that money in there, live off the cash flow, and then let that grow, right? And so savings, it's just there and it's just going to roll over. Maybe I don't like that operator, I'll move to another operator. But basically that once that money's spent, it's like there, right?
Yeah. I like that. So it's like, earned income should go into assets that produce passive income and only increase your lifestyle when the passive income goes up.
Yeah.
All the earned income goes into the assets, and all the equity when you sell these assets should go back into more assets to where you can increase the velocity of money.
Right, because the goal is to have wealth, right? The difference of rich and wealth, right? Rich is like I make $1 million a year. But in California, you make $1 million a year, half goes to taxes. I have 500 grand. I'm married, I have 2 kids. They go to private school. I drive 2 brand new cars. I'm broke. Like I make $1 million a year and I'm broke, right? So that's rich. Wealth is I have assets. So the goal is for me, if I call it my scorecard, right? Like your balance sheet, right? So I look at my balance sheet and my scorecard should always, my goal is to get my scorecard up, right? I want more points on the board. And so my goal is to have more assets when I die and have my grandkids have my assets kind of a thing, right? And so like when people ask me like, at what price will you sell your Bitcoin? It's like, you don't understand how money works, do you? Why would I sell assets? My goal is to get more assets my whole life.
Yeah.
I take my earned income and I turn them into assets. And then my kids and my grandkids get my assets. So yeah, why would I sell it? Now, there are some things, like I said, some speculation down there, but the goal is to get those assets over the long term.
I love that. If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show. Tell me about your fund, man.
Yeah, let's talk about the fund. So I'm a student of history, and when you look through history, you can see that there's been 5 technological revolutions. They're different than a technology. A technological revolution is where basically humanity changes and it drives financial markets. There's been 5. So we had the Industrial Revolution. People worked in farms in the cottage industry, and now machines did the work of 5,000 men. Pretty big deal. Then we had steam engines and railways. Now we could move stuff across continents. Then we had electricity and steel and heavy machinery. Obviously, we don't have to say how much that changed the world. Then we had oil, automobiles, and mass production, 1908. Then we had 1971, we had the age of microprocessors, which brought personal computers, brought the internet, telecommunications, all of that. And they happen about every 50 years. Not only do they change the way the world works, but they drive financial markets. So the markets have been driven by telecom and internet and computers the last 50 years. Before that, it was Ford, GMG. Before that, it was steel, it was oil, right? And so they happen about every 50 years. 1971 till now is about 52, 53 years. And I believe we're entering the 6th technological revolution. And the new revolution is decentralization. So Bitcoin isn't just some like new cool toy. Cryptocurrency, in my opinion, it's a arbitrage on the trend. They're trying to pretend and they're trying to draft off the trend. But the real revolutionary of the technology is Bitcoin. So the decentralization. So now the whole world has, like a pendulum, has been swinging towards centralization. So when the internet came out, it was very decentralized, but now everything goes through Facebook and Google. But now we're swinging back to decentralized protocols. So the way we can communicate, transfer money, all those things are decentralized. So there's a whole revolution. And I believe over the next 50 years, it's going to drive financial markets. And let me put this into perspective. So Bitcoin, per the CFTC, per the SEC, per me, Bitcoin is a commodity. A commodity is something that anybody in the world can go get. So if you get a piece of land in Mexico or Canada or China, you could go dig for gold or drill for oil. And no matter where you get that oil from, oil's fungible. Right? It's exchangeable. So anybody can get it anywhere in the world. It's fungible. It can be exchanged. And there's no common issuer. It's just in the freaking ground. So Bitcoin is very similar. Anyone right now today can get a computer, plug it in, and get Bitcoin. It's fungible, and there's no common issuer. Crypto is a security because it's all been issued by a common issuer. And anyway, I won't get into that. But if you think about this as like Bitcoin being an asset, so what are a commodity? What other commodities do we have? Well, oil. Oil's a commodity. Gold's a commodity, right? So you think about oil for a second. So oil is a commodity. It's an asset. You can buy oil. You can trade oil futures, right? But then there's an oil industry built around it. Who made the new sonar? Who made the new AI sonar to go find oil in the ground? Who came up with the oil tankers that move it across the oceans? Who came up with like the new drill head that allows horizontal drilling to unlock new oil we didn't even know about before, right? So there's an oil industry around oil, the commodity. And so Bitcoin is the same way. So we have Bitcoin being a commodity, but there's an entire industry that's being built around what this new commodity allows us to do. Just like oil now allows us to have shoes, petrochemicals, tires on our car, or cars. So there's an industry built around what oil unlocked for us. And so Bitcoin, most people think it's just like cash, digital cash, which it is, but there's a lot more to it. So there's an entire industry being built around it. Now, back to oil, gold, you should certainly have a little bit of gold in your portfolio, sure, but there's an industry built around gold. And the value is mostly unlocked, the alpha, through investing through the industry, not just owning the asset itself. So oil, since 1971, you referenced we got off the gold standard, it's sort of averaged around $60 to $80 a barrel. It goes higher, it goes lower, but it sort of stays in the $60 to $80 range. Meanwhile, the oil industry is the 8th largest industry in the world. It's worth about $5 trillion. So back to the fund. The fund is not just buying Bitcoin. You should certainly buy Bitcoin and you should certainly hold that. You should. But our fund is...
What's Bitcoin trading at right now?
In the 40 to 45 range right now.
Is it a good time to buy?
I think it's a good time to buy. I think it's a real good time to buy. I'll tell you why real quickly. We just had all these ETFs that launched. And so now anybody with their stock account can just add Bitcoin. It's a pretty big deal. There's a lot of people, I think everyone should own it personally, not through an ETF. However, there's a lot of money, as we already mentioned, locked up in these pension funds, these ERISA funds, things like that. And so those people are able to now buy it through their 401k or mutual fund, as opposed to they weren't able to before. But even bigger than that, because a lot of managers at Charles Schwab and things like that, financial advisors, and the people that run the mutual funds and the 401ks, et cetera, they're managing people's money for them. So these boomers who are never going to buy Bitcoin, their fund manager just bought it and put it in their portfolio. They don't even know about that, right? So there's a lot of demand. It's going to unlock a lot of demand. 72% of financial advisors said they would recommend Bitcoin once there was an ETF. It's a very big deal. And in commodities are different than equities. Equities move on like profitability and valuations. Commodities run on supply and demand. Do I think there's going to be more demand for oil or less demand for oil in the future? And more supply or whatever. So Bitcoin, you can mine it, like I said, just like gold. Right now, I think there's 900 Bitcoin per day being mined into existence. The ETFs are gobbling up right now.
What does that mean, by the way? Like when someone's creating or they're mining Bitcoin, what does that mean? It's not just growing like a tree, right? What is that?
Yeah, so just like I would go find a piece of dirt and I would dig for oil or gold, I can buy a computer and I can go mine for Bitcoin. So the computer, basically, I'm going to dumb it down, but it basically logs onto the open source, permissionless Bitcoin network, and it starts processing transactions. And by processing transactions, it can earn in two ways. One, I get a percentage of the transaction fee. And two, every block, every 10 minutes, because it's like a blockchain, every 10 minutes, another block is added and new coins are unlocked. And then those get split by whoever won that. So a Bitcoin miner would basically join a pool. Hey, I'm going to join with 1 million other people and we're all going to work together. And if we find a block and get a reward, we'll divide it up between us. So there's a handful of pools, right, that do this. So that's basically how it works. So I earn in two ways. If I discover a new block, a reward, then I get a percentage of that block reward.
Gotcha.
So 900 Bitcoin are being unlocked and released.
Every day.
Every 10 minutes. There's more, but that's the total for the day. Every 4 years, that amount gets cut in half.
Why is that?
Because it has a predictable supply schedule. So it was programmed in. So every 4 years, it gets cut. The amount that gets released gets cut in half. So it creates this supply shock.
Yeah. Scarcity creates demand.
So if the demand stays the same, but the supply gets cut in half, what happens?
Prices go up.
Price go up. So what happens if the demand goes up?
Goes up even more.
Even more. So now we have these ETFs. The ETFs right now, they've been going for a couple of weeks at this point. They're adding 9,000 Bitcoin a day. That's 10 times the amount that's being released. Now, when the halving comes, which is in about 3 or 4 months from now.
What does that mean again?
That means the new supply gets cut in half.
Okay, got it.
So
that's every 12 months.
every 4 years.
Got it.
So this is going to happen in the next couple of months. It happens on a certain amount of block. We don't know the exact date, but it's going to be around probably April of this year. The supply will get cut in half. So they're buying 9,000 a day. If that stays the same and you go from 900 a day to 4, whatever it is, 100 a day, what happens with the price?
Goes up.
Potentially, if the demand stays the same,
Yeah.
right? Which it seems like the demand is going up. Now, why would the demand go up? Why would somebody need something like that? So, one, governments are printing unlimited amounts of money. We talked about this, $1 trillion every 90 days. Do you think, and this is not just the United States, China, ECB, Europe, they're worse. Do you think governments decide to stop printing money and live on a balanced budget? The chance of that is very slim.
Yep.
Okay. So as long as they continue to print more money, people need a fixed supply to store their wealth. 2, this is not a trend I'm happy about, but governments are obviously becoming much more authoritarian. They want to control every single transaction and all that. And so do you think governments become more authoritarian and less in the future? And
More.
It seems like we're on that trend, right? So all these trends push towards more reason, more demand for something like Bitcoin. For me to be able to hold my money in a way you can't debase and steal from me. And I want to be able to send it to you without somebody stopping and blocking that transaction. And I think the demand from a political and a financial standpoint globally pushes it up.
Now, I got a question for you. So this is outside of the ETFs, but all these Bitcoin investors, do you think the majority of them are parking their money in Bitcoin because they just want to store it and they're concerned about the inflation in the US dollar and some of these other currencies around the world? Or do you think they're parking it in Bitcoin because they want to make a return as an investment? Because really 2 different strategies, right?
So I think it depends on the person. So there's certainly the short-term speculators. But let me ask you another question. I'll put it in real estate terms. We're in downtown San Diego. Beautiful, beautiful city. If your great-grandfather came here to San Diego when he was your age, nothing was here, right? He could have bought 6, 7 of these city blocks downtown.
Mm-hmm.
When would have been the right time for him to sell those? Never.
Yeah, I mean, the best time to buy real estate is always 10 years ago.
Right, but if your great grandfather bought 6 or 7 city blocks down here on the waterfront in San Diego, when should he have sold those? Never.
Yeah.
You would hopefully be able to get those, and your grandkids would right? Why? Well, 1, because they always keep going up, and 2, if he sold those 6 city blocks, how does he ever buy those again? So again, back to assets. So the smart investors like Michael Saylor, they're buying forever. Just like I would buy 6 city blocks and own those forever. Just like I bought, 100 acres out in Rancho Santa Fe and forever, right? So I think the best investors that know what they're doing, that understand the way the game of wealth works, they buy forever. And then there's certainly the speculators, for sure. I think the speculators are much lower, and I can tell you why. We know this statistically.
Those are more like the day traders and those types of folks.
Yeah, or the people are like, hey, I think it's going to double my money. I'm going to buy a boat next year.
Yeah.
Cool. So you're going to go buy a depreciation asset.
Yeah.
Cool. Bitcoin's averaged a 200% compounded annual growth rate.
Since its inception?
Over 200, like 220%
Wow.
compounded annual growth rate. Let's just say that slows down to 150 and 20. I mean, even at 25, even at 10, I mean, nothing does that. So why would you sell it to go buy a boat or a car or whatever it is, right? So that's number 1. But we know because Bitcoin is an open source blockchain, we can see all the data on there. And what we can see is we can see when coins move. It's not private, so we can see it, but it's anonymous. We don't know who owns the addresses. But what we know is that 57% of Bitcoin has not moved in over 2 years. Hasn't moved. 71% has not moved in 12 months. Those aren't speculators.
Yeah.
When it dipped down to 18,000 and then went back up to 50, don't you think those speculators would have sold? But they didn't. So why didn't they sell? Well, probably because they're thinking very long term. We know that there will never be more than 21 million. There's somewhere, we don't know exactly how much is free floating because a lot has been lost for good. People lose their keys. There's about, based off of those numbers, how long it's been moving. And we can see, is it sitting on an exchange or is it sitting in somebody else's private wallet? There's about 1.5 million Bitcoin available for purchase, freely being exchanged.
What was the reason it dipped? Because the high was like 65K or something like that. And then it dipped down to, you said 18,000.
It got down to about 16, just under 16.
And that's just fear-based? Is that why people sold and then it just dipped like that? I mean, it's just fear?
I like to say, so we would call that...
Because it's an emotional reaction to the marketplace.
Well, we call that volatility. So why do prices go up and down? So what I like to say is volatility is the difference between perception and reality. Like, oh my gosh, Bitcoin's going to be the biggest thing in the world. Everyone's going to buy it. Hyper-Bitcoinization. oh, maybe not. Whew. And then the
Mm.
price goes down. And then, oh my gosh, I can't believe it's so cheap. It's going to go up. And then, and it goes up. So the reality is like this trend line, but perception and reality goes like this, right? So no different than why, like I said, real estate goes up and down, kind of the same thing, right? Like, oh my gosh, the whole world's going to come to an end. I'm going to take some profits off the table. And then it kind of pushes it down too far. So then it gets oversold and then people buy it back up.
Love that. So tying back to your fund.
Oh yeah, so back to the fund. The fund is basically investing through the entire ecosystem. So like I said, you should certainly buy Bitcoin and you should do that first. But if you want to get into a lot of these companies that are building on Bitcoin, then we invest through those. And so, just like a fund, like most of these companies are early stage, venture round. We typically get to them a little bit later in the stages, but they're not publicly being traded. So there's really no way to get access to them. So our fund is able to invest into these and then you can kind of get access to them in our fund. I've been an advisor for a VC fund, a Bitcoin VC fund called Trammell Venture Partners, maybe 3 years now. But that's like early stage, long only. So it's like, hey, let's make 15 of these bets. Let's hope that 2 of them pay off, kind of a thing. So it's super high risk, high reward. Long term, meaning your money is typically locked up 7 to 10 years. And then hopefully something happens at the end of that. The new fund that we've set up is what we call a hybrid fund. So 70% private and then 30% public. And so 30% of the fund's money we're actively putting into public plays. The reason why we're doing that is we're using the public portion to hedge our positions, to offset, to do shorts, to do different types of trading strategies so we can generate alpha, but we also limit our downside, right? So like those long-only funds, they're high risk, high reward. You're locked up for 7 to 10 years. Our goal is not to outperform those. Our goal is to return a better risk-adjusted return. So less drawdown, maybe not as much upside, but a less drawdown. And also we have shorter duration. So you can have more liquidity in years as opposed to decades. So that's sort of what the goal is with the fund. Nobody's doing anything like that in the space. Like I said, there's several venture capital funds. No one's done a fund like this. My 2 managing partners of the fund are long-term ex-Wall Street execs, so they kind of really have that very intricate financial strategy down. And so far, it's been really good. We just closed the first fund, and we raised during like the worst bear market you could raise in. So it was a little bit disappointing from that perspective. But we're already showing really good profits. It's very profitable already. So we'll probably open up the second fund maybe in the next 6 months or so.
Okay, I love that. Well, dude, I appreciate you taking the time to come on, man. This has been a super intriguing episode for me. I mean, just the conversation definitely got my wheels turning. And when I'm up in San Clemente next, dude, let's
for sure
let's rip another one in your studio, man. I'm excited to check it out.
Yeah.
Where can listeners learn more about you, learn more about the fund, YouTube channel, all that sort of stuff?
Yeah, just onemarkmoss.com. That's the number one. Onemarkmoss.com is like everything's linked there on my website. Otherwise, I'm pretty easy to find on Google. Just Google or YouTube Mark Moss and check it out.
Love that. Well, till next time, he's Mark Moss. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.